This content does not take into account your investment needs or personal circumstances. It is not intended to be viewed as investment or financial advice. For more financial information, please visit milfordasset.com/getting-advice.
Kia ora, friends, and welcome to Laugh My Assets Off, a show where you've done the mahi so you get the treats, but then you want to put the treats away so they can potentially grow into even bigger treats. Joining me, as always, are two people who know a lot about money. Little Apprentice throwback there. It's Caitlin Parker and Liam Robinson. How are you doing today?
Good, how are you?
Yeah, good. Great to have you back in this lounge that we live in. Today, we're talking about good investment companies and portfolios, which it turns out are so much more than just the way you submit your NCEA art at the end of the year. Let's start talking portfolios. What is a portfolio?
An investment portfolio is essentially just a collection of your investments.
Makes sense. How big does the collection have to be? For instance, my sharesies that are in Canada South and Air New Zealand, just two things. Is that enough to be a portfolio?
Yeah, it is. It's a very concentrated portfolio. And as you know, we would advocate for a more diversified and spread your eggs. But yeah, that's definitely a portfolio. If you think about your investment portfolio, yes, you have your sharesies account, but you also have a property. You also have your KiwiSaver as well. So you need to think, top down, you already have a bit of diversification there. You have property, shares, etc. So you are the owner of an investment portfolio.
Oh, I didn't even know it. But I'm feeling very proud of myself now. Who knew? Let's talk about building up a portfolio. What does that mean? So my portfolio is like a manila folder with all of my headshots, and it says that I can do all the accents, but I actually can't do South African. How do you guys go about creating a portfolio?
I think, say when you're looking at it and you're like, I want to create a portfolio, you need to first of all start thinking about what's your objective. What do you want this portfolio to achieve? So for us, when we have a fund, it has a clear objective that it wants to deliver on, and that really sets the parameters on how you're going to construct this fund from the bottom up.
And those objectives, are they like the aggressive balanced growth things that we've talked about?
Yeah, so it's like, some funds might have an objective that it's to beat the official cash rate plus 2% or plus 5% over its recommended time frame. Others will be to beat the NZX 50. It'll be relative funds.
There could also be portfolios out there that invest in specific asset classes. So you could have a fund that invests only in New Zealand property companies, for example, and that might be beneficial to someone who can't quite afford to get on the property ladder yet, but wants to invest in New Zealand property. You could have a fund that only invests in clean technology, a fund that only invests in bonds. So you do have sort of single mandate funds as well, where you can get exposure to a specific industry if you're passionate about that industry. Could be crypto.
True. What if you wanted to invest only in companies with the same colour logo, so that when you look at them all together, it kind of looks pretty?
It could be a hole in the market. If you, I reckon you could run with that.
Yeah. Okay. Time to start my own asset management company. That's what the show's all about.
Yeah.
Do you think I should have a portfolio that's quite specific like that, like that's only bonds or only Trans-Tasman shares?
Look, I can't give you advice on that specifically because we need to go through an advice process. But I think you already are quite diversified in the sense that you've got your property, you've got a sharesies account, you've got your KiwiSaver. So you may not need to go down a specific avenue of investing only in one asset class because you do have a broad base to begin with. So you might be more focused on your goals and your time frame rather than specific assets, if that makes sense. So if we look at your KiwiSaver, you've got 31 years, not 30 years.
30 years and 10 days.
Yeah, that's right. So, rather than thinking, I need to get into New Zealand property or wind farms or something along those lines, you may just be thinking more broadly, I need to be in riskier types of assets in general because they're going to give me better growth over a 30-year time frame.
So, talking about portfolios, I've obviously got just two in my terrible sharesies portfolio. What is an ideal number to have?
Look, there's no hard and fast rule, but I think as a rule of thumb, you'd probably want at least 20 companies. And if you look around the market in New Zealand at specific funds that are provided by fund managers like Milford, you typically wouldn't find a managed fund that had less than 20 companies. And if you think about it, if you did have 20 companies, then your maximum exposure per company is only going to be 5%. So if a referendum comes along or a pandemic happens, you're only exposed to that specific incident to 5%. So that would be a good starting point, I think. But of course, you've got to have time to invest in not just 20 companies, but you might need to look at 200 to find those 20. So the way I explain it to clients sometimes is we've got 40 analysts in our investment team, all spending 40 to 50 hours a week researching. That's 2,000 hours a week. Do you have that time to offer it to it yourself?
I don't think anyone has 2,000 hours a week.
I don't think so.
Just trying to do that math in my head, but I think I've got, how many hours do I have?
It's like 168 or something.
Wow. You are good at maths.
Oh, I don't know if that's right.
So portfolio building is something I can do myself with Sharesies, but I'm hearing that I probably don't have the knowledge or the time to just be tackling that by myself, maybe.
It's a lot of time, right? You know, we're spending all day, every day looking at these companies and making constant different decisions. So if it is something that you want to do, you know, monitoring 20 companies, that is a lot of work. It's definitely good for a hobby and if people want to get skin in the game and see how these things work. But building up a portfolio, it's like anything. If you don't have the time, the expertise, the knowledge, the training, it is easier to outsource.
Yeah, I have a hard enough time monitoring my own emails.
Yeah.
I don't want to even see how many are unread. Does Milford see Sharesies as a competitor? And what about other investment apps like Jester's Magic Jackpot Casino or Monopoly Go?
I can't probably speak to the last two that you named, but Sharesies, look, no, not a direct competitor. They offer a very different service, so they enable people to sign up and buy individual companies. You can also buy funds, and Milford is actually available as a fund on Sharesies, so you can invest with us through them. But they don't have an investment team. They aren't fund managers. They aren't running their own funds. They're really just a platform where you can buy other products and services in the financial services sector. So rather than being a direct provider of the service, they're sort of a platform, a middleman, if you like.
What makes you guys better at choosing companies than me? Because I obviously don't have education for it, but I do have a lot of confidence.
I think it's a mixture of qualifications. So, typically speaking, the investment team, they've all been to university and may have postgraduate qualifications as well, but it's also experience. So time in the trenches, so to speak. A lot of the senior people in the investment team have invested through several recessions and economic crises, and they're able to pass that knowledge on to the younger investment team and build up that sort of diversity of knowledge that you can't necessarily just learn university or informal qualifications.
True. Well, I did watch Wolf of Wall Street though, so I learned a little bit from that.
It's a good start.
It's a good film.
Yeah.
It's mainly about not taking drugs.
To be honest though, confidence is good because one of the things that you need to be able to do is make a decision. And like we said, you're never always going to make the right decision 100% of the time. But you do need to decide, you can't just sit on the fence the whole time. So with your confidence, that's already kind of step one.
Oh, thank you.
No worries.
Wow. What is Milford's process for choosing investments? Is it like The Bachelor? Do you sort of stand at the front and hand out roses and be like, Auckland Airport, we've chosen you?
No.
You should, it'll be fun.
That would be fun. So look, like everything, you need a good framework. So our investment team in Milford, we have a very robust framework that has you can repeat that framework and it's been very successful. So there's a lot of inputs that go into it. So when we look at a company, we're not just looking at the figures. We do a SWOT analysis, right? So SWOT, strengths, weaknesses, opportunities, threats. That's how you'll initially look at a company. You can do it on anything. You can do it on yourself as well. It's pretty easy to do, a bit of a self-assessment.
I do it every time I walk into a room. Opportunity, weakness, threat.
There's a lot of inputs. It's a qualitative decision. We'd also look in terms of, what is the market expecting for this company? Are we different from it? What is the selling point for this company? What's the competitive landscape like? Is it easy for someone else to come in and be a competitor straight away, or is there a high barrier to entry? And then we'd also do a lot of peer review. So we have a big team, a lot of experience in the team, and we would generally, sit around, debate it, getting different people's perspectives as well. So it's a very robust framework, but it is one that we can apply to every investment, and it's repeatable as well. But it does take time to build up that knowledge as well, and it's very much taken a lot of time and detail, and it's not just throwing darts and hoping that one lands, or handing out roses.
True, and I guess you can't get it right all the time, right? Because I can imagine in like 2008, you'd be seeing all the frozen yogurt shops popping up. You'd be like, I'm investing in frozen yogurt. It's everywhere. Lo and behold, there's not a frozen yogurt shop to be found anymore. Don't know if you guys invest in frozen yogurt or not.
No, that's actually...
I hadn't realised that
Good
they have
point.
disappeared, but you're right.
God, they were up here. I couldn't tell you where the nearest frozen yogurt shop is.
No.
There used to be one near me. Yeah, that's a good point.
They're
Eli.
gone. R.I.P.
Yeah.
Conspiracy, I reckon.
Yeah, it was the government. The government got rid of them.
Look, you're never going to get everything right 100% of the time. And just in terms of, markets in general, there's a lot of different drivers. So sometimes companies will, do good, whilst other companies will be lagging. But it's just about that constant reassessment and forward looking. So, if a company has a bad period, it's about reassessing, sitting down, debating, looking at the drivers. Do you still believe in the thesis for this company? But yeah, look, no one's going to get it right 100% of the time. And there is going to be prices going up and prices going down. But again, you've experienced it with your sharesies with just having 2 companies. If you had 200 companies, the impact of one of them going down isn't going to be as great on your portfolio. So
Yeah.
it's about that diversification.
Even just maybe picking one other company that wasn't relying on a referendum or or a pandemic not happening.
Yeah, look, it would have lessened the impact.
Would have helped me. So I guess what I'm hearing from you guys is that I can go on my sharesies on my phone, have a play around, click on some things, but it is a little bit like I'm having a play around. I don't really have the knowledge of what I'm up to on there.
Yeah, look, definitely. And if it's something you're interested in and, a hobby to kind of take a bet in a company and watch how it goes, that's fine, but I would not be putting a substantial amount of your money behind it when you openly said you don't have the expertise, you don't have a clue what you're doing. Why on earth would you put all the money that you've worked so hard for behind you backing these companies that you're just kind of throwing a dart at? So if you want to generate wealth, you want to put it somewhere that you trust. And if you're investing in a fund, the people managing that money, they have experience, they're educated in this. This is what they do day in, day out. It's their bread and butter. So you're putting your money in the hands of people who are essentially more capable. And, there's a reason they have a job. There's a reason that we have jobs to do this. And, when you're putting your money into a fund, you're getting the expertise of huge investment teams, massive knowledge. They're meeting the companies. We're watching these companies day in, day out.
Yeah, and I suppose me alone at home on my phone, I'm so far from doing any of that.
Exactly.
work.
You mentioned, was it Air New Zealand is the other company. Have you ever looked at their annual reports?
I met Christopher Luxon once.
You don't have it. It's not the time. So again, it's all fun and games, and $100 or a few $100 in there. But if you want to generate wealth for the future in investing, you really want to put it somewhere that you trust the people know what they're doing.
And I think I'll just add one point to that as well is, if you are on something like Sharesies or another platform, they can't advise you on which shares to buy, where to put your money, but a fund manager can advise you on what fund to pick. So I think that advice piece is really important as well, because sometimes people need guidance to put their money in the right place, right?
What are some signs of like a good, healthy portfolio? Does it have a glow like a pregnant woman does?
Look, I think a healthy portfolio is one that is performing as per its objective. So, if you have a conservative fund, you don't want it to be too volatile. You want it to be fairly steady. It's not always going to go up, but when markets are volatile, you don't want it to be having huge downward swings. You want it to be fairly stable. If you have a growth fund, then you want it to be going up when markets are going up. You don't want to be missing out. So it's all relative to the objective of the fund. The reason you've chosen that fund is because it should align with your goal and your time frame and your risk tolerance. So a healthy portfolio should meet those objectives. It's not going to meet it exactly, but it should be within those parameters. If it's not, then I would say that's a sign of an unhealthy portfolio, so to speak.
Basically, if it does what it says on the tin at the end of the day.
What's the 10?
The tin is the objective.
Yeah.
Disclosure statement.
Exactly. So like the information guide that you chose this fund based on, and if it does exactly what it says it's going to do over the recommended time frame, then you know.
That could be a good bit of marketing if you actually sent people tins of what their fund management was, and then you open them and then they pop out like little snakes.
We'll table that. I'll
Yeah.
bring it to one of those
All the
discussions.
little companies you're invested in. I don't know, could be a fun Christmas treat.
Could be, or also,
A waste
fees
of-
that you're paying, that could be a waste of it. You might
Yeah.
be giving out if you're paying a fee and then you get this fancy tin.
Yeah, maybe scrap the fancy 10 ideas. Do you guys ever put unusual little companies into portfolios? Like I'm thinking of things like Rocket Lab, or like if there was a new company in AI, which is obviously very new tech and we don't know what it's going to turn into. Do you invest in companies like that?
Those companies would come under our private equity team. So our private equity team would invest in, startup companies, and that's where that exposure would be. In terms of, if there's a new trend that's like AI, that's over the past few years, the majority of our funds will invest in companies that are listed, on the stock markets. But we can still benefit from that. There's a lot of chip manufacturers that are going to benefit from AI and, those models and helping learn the languages, etc. So there is a lot of opportunities when, there's a new startup that everyone's raving about. You need to actually think about, okay, well, if this is a new trend or, this is a massive area of growth, what companies can I actually get exposure to that maybe not directly, but indirectly are going to benefit from it?
You can think of it like if there's a gold rush, rather than buying the gold, you buy the picks and shovels.
True.
Because not every gold miner will find gold. So it could be
Yes.
quite risky if you backed a specific gold miner heading off to, pan for gold or whatnot. But if you sell them the material that they need to go and prospect for it, then you'll benefit from a gold rush in general.
Oh, and they might use those pickaxes for something else.
They might.
Yeah.
That's right.
All right. So if I'm in a balanced or a conservative or a growth fund, does that mean that fund will be in different companies than it would be if I was in one of the other ones?
It may do, yeah. So if we think about a growth fund, firstly, it is going to have a higher exposure to companies, to shares, but those companies may be in more risky or growth orientated fields. So a common one at the moment is the technology sector. With the implementation of AI, it's expected that that's going to grow and grow and grow. It might not though, so there is a risk there. So you might expect technological companies to be in that sort of field and held in growth funds. But if you think about a conservative fund, it might hold companies in more defensive sectors. If we think about a local example, you might think about power companies. Power company, great company to own. We all need power, and so their income is fairly steady, but their growth trajectory might be quite limited. If you think about in New Zealand, there's 5 million of us here, so there's 5 million people you can sell power to. For that company to double, it would need to sell double the amount of power, and is the New Zealand population going to double in the next few years? Hopefully not. The traffic's already bad enough. So, their share price might not have a huge trajectory, but it is a safe asset to own because their income is fairly regular.
Yeah, so electricity is never going out of fashion, but it's also never going to go in fashion more than it already is.
Well, look, there'll be some changes. With the move to renewable power, more EVs on the roads and things, our demand for power is likely to increase, but it's probably less of a growth story than AI coming in and changing the way we do everything.
True. Well, this has been great. I think we've learnt that my portfolio is too small currently, and that having a more diverse portfolio is definitely better in the long run. That's been our chat about portfolios. We only have one more episode of Laugh My Assets Off. Thank you, Caitlin. Thank you, Liam. Next time, it's time for you to quiz me on what we've learnt.